Welcome back to Morning Markets on Thursday the 16th of February. In terms of market developments over the last 24 hours, global equities were up 1.5%. US bond yields rose by 6 basis points and the US dollar strengthened given the dispersion which we're seeing in terms of expected policy rates at this point in time. Yesterday we discussed the important developments which are emerging in respect of US inflation data. A positive trend is underway. We're seeing inflation cooling. The current headline level is 6.4%, and that's down from the summer highs of 9.1%. However, we're still more than 3 times above the central bank target. To combat inflation, the Federal Reserve, so the US Central Bank, have raised rates by 4.5% in the space of 11 months to cool inflationary demand. And analysts were starting to get very comfortable with the idea that we were in touching distance of the peak or the end of the interest rate hiking cycle in the US. A challenge for the Federal Reserve to contend with in this journey of cooling demand is the strength of labour markets and the tailwind which that gives to consumers and their ability to go out there and spend. There are various data points along this journey of cooling demand which will provide an important insight into the success of the monetary policy enacted by the US Central Bank. An important one yesterday was US retail sales data. This reflects the total amount spent in dollar terms on goods and food products in the US. Retail sales grew by 3% between December and the end of January, so that was more than 1.2% ahead of analysts' expectations, with evidence that consumers are still going out and spending in department stores, supermarkets and bars despite the increase in lending costs which we've seen. However, the bounce back in January was also in part viewed to be the result of milder weather after a particularly cold December, which was preventing people from heading out into the shops. And even after adjusting for inflation, so the increase in the cost of goods, we saw retail sales tick up. The strength of the non-farm payroll data, which we had on the 3rd of February, put wind in the sails of several Federal Reserve members to support their argument that they expect interest rates to remain at the high levels through the course of 2023, rather than cutting through 2023, which was starting to come into markets' expectations. The reason for holding is because they need to bring inflation towards that target, so there's more work to be done there, which we have sympathy with. It will be important to see how data points evolve in terms of the strength of the consumer in the coming weeks and coming months, and we'll keep you up to date on that here on Morning Markets. We also heard from the President of the European Central Bank yesterday, Christine Lagarde, just a few days after we had confirmation that Europe avoided a technical recession in the fourth quarter. Within the session, Lagarde made clear that there was more work to be done in terms of tackling inflation and that they intend on raising interest rates in their March meeting. Whilst topical here in the UK, the announcement of Nicola Sturgeon offering resignation had no impact on international markets. The weakness in the pound was more essentially influenced by the softening of UK inflation data, which we had through the course of the week. Thank you very much for watching. We look forward to bringing you up to date tomorrow here on Morning Markets.
If you're interested in taking your investing to the next level or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.